Forex is often touted as the biggest market to trade in the world, but what actually is it? Forex, short for foreign exchange, is the global marketplace for exchanging national currencies. Imagine being able to trade the US dollar for the euro, the British pound for the Japanese yen. That's Forex. It operates 24 hours a day, 5 days a week, and boasts a daily trading volume of over $6 trillion, making it the most liquid market in the world. But why is Forex so appealing? Let's break it down. Firstly, its massive liquidity ensures that trades are executed swiftly, minimizing the risk of price manipulation and providing a stable trading environment. Liquidity in Forex means you can enter and exit trades at any time, with very low transaction costs, which is crucial for day traders and scalpers looking for quick profits. Secondly, leverage offered by Forex brokers allows traders to control large positions with relatively small capital. Imagine being able to trade $100,000 worth of currency with just $1,000. This leverage can amplify profits, but it also means that losses can add up quickly, so risk management is key. Lastly, the market's continuous operation means you can trade at almost any time that suits you. Whether you're an early bird or a night owl, there's always a trading session open somewhere in the world. This flexibility means you can fit trading around your work or school schedule. The main trading sessions are the London, New York, Tokyo, and Sydney sessions, and each has its own unique characteristics and opportunities. But how does Forex trading actually work? It's all about speculating on the price movements of currency pairs. When you trade Forex, you're essentially betting on whether one currency will strengthen or weaken against another. For example, if you think the euro will rise against the US dollar, you'd buy the EUR-USD pair. If you're right, you profit from the change in the exchange rate. Conversely, if you think the euro will fall against the US dollar, you'd sell the EUR-USD pair. To dive deeper, let's look at some key concepts. Pips, for instance, are the units of measurement used to express the change in value between two currencies. If the EUR-USD pair moves from 1.1050 to 1.1051, that 1 pip movement might seem small, but when trading large amounts, it can result in significant profits or losses. Another critical aspect is understanding market analysis. There are two main types: technical and fundamental analysis. Technical analysis involves studying price charts and using indicators to predict future movements. Common tools include moving averages, trend lines, and oscillators like the RSI, Relative Strength Index. On the other hand, fundamental analysis looks at economic indicators, political events, and news releases that can impact currency values. Key reports to watch include GDP growth rates, employment figures, and central bank interest rate decisions. To get started with Forex trading, you'll need to open an account with a reputable Forex broker. Look for one that offers a user-friendly platform, competitive spreads, and strong customer support. After opening an account, deposit funds and choose a trading platform that suits your needs. Many brokers offer platforms like MetaTrader 4 or 5, which are packed with features for analyzing and executing trades. Once you're set up, it's crucial to educate yourself on trading strategies, risk management, and market analysis. There are plenty of resources available, including online courses, webinars, and trading communities where you can learn from experienced traders. Start with a demo account to practice your skills without risking real money. Forex trading offers exciting opportunities, but it's essential to approach it with knowledge and caution. Ready to learn more and take your first steps into the Forex market? Hit that like button, subscribe to our channel, and turn on notifications so you never miss our expert tips and insights. Thanks for watching, and we'll see you in the next video.